Shares of Coca-Cola falling after reporting declining volumes in its latest quarter, as rising prices do weigh on consumer demand. Our next guest, though, still seeing potential upside for the company's volume growth in the fourth quarter, also saying that Coca-Cola's current valuation is extremely attractive. Joining us now, we want to bring in Filippo Falorni. He is the lead analyst for U.S. beverages, household products, and personal care at Citi. Filippo, it's great to have you here. So when you take a look at the street's reaction, looks like we're seeing a bit of a disappointment with shares off just about 2%. A lot of that having to do with maybe questions surrounding pricing power. I was reading your note this morning. That first line said that you actually view the third quarter results as solid. So why aren't you concerned maybe about the pricing power of Coca-Cola?
Yes, thanks for having me, Shauna. Look, I think generally the quarter was, I think it was extremely solid in the context of a global macro environment, which has been very volatile, right? Like Coca-Cola is a true multinational company, over 70% of sales outside of the US. And their ability to really grow organic sales, which is the metric that we track more closely, at a 9% rate, I think is extreme confidence of extreme solidity in their results, both from a price mix standpoint and also volumes. Look, volumes were down 1%, and that's what drove a little bit of the disappointment today in the quarter. Consensus was more expecting flattish volumes in this coming quarter. But really, the reality is that they had a lot of impacts, some of it which are very temporary, like some negative weather in India, a little bit of weakness in Mexico on cycling really difficult comparisons, and some continued pressure in China and the Middle East, most of which should get better already starting into next quarter. Next quarter, they also have 2 extra days. So I'm expecting an acceleration in volume growth in Q4. And from a pricing standpoint, look, a lot of companies have been taking a lot of pricing in the CPG space over the last 2 years. The difference for Coca-Cola is a lot of it is also mix driven. When you think about like they're growing with higher priced products like Fairlife in the US, they're also getting packaging mix benefits. And so I do think that pricing line item that is driven a lot of the growth for this year is going to continue into next year.
Do you think, given that there was pressure on that unit sales volume, but they were able to experience some lift to the upside off of that pricing power, means that they should consider raising prices even more?
That's a good question, Madison. I think they've taken a lot of pricing over the last couple of years. As I mentioned, it's not entirely list pricing. A lot of it is mix driven. So it's pack sizes, smaller cans, smaller bottles that carry higher price per same amount of volumes. So I'm not expecting them to take a lot more, but I expect that line item to continue to be a strong positive contributor to top line growth. So if you think about their long-term target is 4 to 6% top line. This year, they're running at 12%. So more than double the high end of their long-term target. Next year, I think they're going to get back towards the long-term target, probably the higher end, but it's going to be a little bit more balanced between volume, price, and mix.
What is, because this is something that the CEO, James Quincey, was asked about on the earnings call, and he said that next year that Coca-Cola was going to return to a more normalized pricing environment. I guess my question to you, what is more normalized?
Yeah, that's a good question, Shauna, because pricing has been very elevated over the last couple of years. Look, typically, when you think about their markets, there's more pricing in emerging markets. Emerging markets are 40% of their sales. Think about like Latin America, Asia, Africa, Eurasia. And typically, they've been taking around 10% pricing in those markets. In developed markets, historically, pricing has been more in the 1 to 2% range. But in the last couple of years, it's been running more in the 8 to 10% range. So I would expect particularly the developed market pricing to normalize. When you think about total company, I think if you go from recently they've been doing 10% plus on pricing, I think that's going to probably normalize more to the 3 to 4% range into next year.
How are you thinking just more broadly about the macro impact on some of these consumer staple names? Obviously today there's, and discretionary names I should say too, because today there's a lot of pressure in the space. You've got the McDonald's news, the Starbucks news, obviously these earnings from Coca-Cola. When you look at the totality of that data, what does it tell you about these sectors moving forward?
Yeah, absolutely. Look, I mean, we've seen definitely some pressure in the US, especially among low-income consumers, reducing some of the more discretionary purchases, as you mentioned. So obviously, the on-premise part of the Coca-Cola business, so that would include the McDonald's of the world, have definitely been weaker for them compared to the at-home side of the business. Because at home, clearly, there's a pricing differential, and people, when the macro conditions are a bit softer, tend to shift consumption from away from home into at home. So Coca-Cola have obviously both exposures. So they've seen some pressure in the away from home side. They did get asked today about the McDonald's exposure, given the recent issue with the E. coli outbreak. They sounded like the real exposure, the direct exposure, is going to be pretty minimal to them. If you think about their U.S. business, QSR is probably only somewhere around 20% of the Coca-Cola business. And yes, McDonald's is their largest customer, but it's still relatively contained, and they have exposure to most of the other QSRs. So if demand shifts, that would be less of an impact for them.
Filippo, is Coca-Cola, is it your top name in the space?
Yeah, that remains our top name, because when I think about the long-term organic sales growth profile of this business, I do have a high confidence that it can continue to deliver at the high end of the long-term algorithm, which will be about 6%. As I mentioned, this year they're doing 12%, so they're doing double the upper end of the algorithm. But I do think they can continue to stay in the 6% range. And the valuation, to me, is pretty attractive. It trades only at 23 times on 2025 numbers. Most of the comparable company in my space, they trade at least 25 to 26 times. So it's trading at a discount. The fundamentals are solid, and I think they're going to continue to be solid into 2025.
All right, Filippo Falorni, thank you so much for joining us. Appreciate it.
Thanks for having me.